the markets rethink the Fed. A very interesting setup here for investors a day after something of a more circumspect response in the immediate aftermath of the tectonic decision that the Fed gave us yesterday. And so what we're going to do here is we're going to take a look and see if that read was the correct one, this read were the correct one, and in general, what these markets might do next. First, where the seesaw came from, why it looks like a seesaw rather than just exactly what you might expect after a Fed rate cut, especially one that so thoroughly meets the market's very dovish expectations, and what this means going forward. So first, let's do a bit of counting up here. This is what the markets looked like as we got into the close today. So this is the day immediately after the Fed. And the optimism here is unmistakable. Stocks up nearly 1.7% if we look at the overall kind of catch-all S&P 500. NASDAQ up 2.5%. A switching around of the yield curve that gives us some steepening, rates down at the front end, the 2-year off almost 1%. The long end, though, the 10-year actually edging up a little bit higher, which is an important part of this story, which we'll get to momentarily. Gold up, oil up, although it's tempting to lump in oil into this narrative, but it has been a creature of its own designs just as often as it's fallen in with macro crosswinds in recent months. So maybe a slight grain of salt there, but the yen is weaker. The dollar is on softer footing. The euro here a little bit higher. And the risk on asset for risky assets, Bitcoin, up over 5%. So clearly there is a very risk-on tone here. Moreover, that we are seeing the shifting that we see in the yield curve is especially interesting in this context, because what this implies, of course, is that there is some dovish momentum at the front end. Clearly, the Fed just cut 50 basis points and then promised the markets that it would add up to 100 basis points for this year and at least another 100 basis points for next year, which of course loudly endorses exactly what the markets were baking into Fed funds futures ahead of this announcement. So the Fed has essentially said, you've set a high bar for dovish readjustment. Here you are, exactly what you wanted. But when we see that there is a bit of strength in the long end, we get the steepening of the curve. That suggests essentially that what the Fed is doing is going to work, that we're going to get the soft landing, that the economy will reflate as a consequence of these rate cuts, that we are not delivering stimulus to an economy that's ailing, to some sort of patient here that needs a lifeline. No. This suggests that what we're doing is we're taking money, making it cheaper, and thereby pouring gasoline on a fire that is far from out. And that what this will mean is higher rates downwind. In other words, that what this is a reflationary situation where we're adding stimulus to growth that isn't bad, rather than adding stimulus to an economy that needs support. So very positive indications here one day after the Fed, and very much a seesaw from the market's initial response, which makes for an interesting dichotomy. Consider what we had yesterday in the immediate aftermath of the Fed, and then when we ended up with today. This is just the S&P 500, and we'll rattle off a few of these assets just to get the contrast. This was yesterday's candle immediately after the Fed. It isn't as though the markets didn't recognize that the Fed was dovish, hence the very significant swing high here. The markets did rally. They got the message. They did not misread. They saw that the Fed gave them all of the dovish hopes that they had carrying into this announcement. And then not only could they not sustain the highs, they turned around and closed down. Then, of course, today, a rethink. And we're back at the highs we saw in July. Not quite over them, but at least back at them. It's a similar story for the NASDAQ. We're not back at the July highs today. We're back at the ones from August. And again, not clearing them, but at least we're there. And yesterday, a circumspect response. Again, we get the rally. There it is. And then the markets fade and fall apart, despite the Fed giving them exactly what they wanted. The same story occurs in gold. This, of course, a foil for interest rates that tends to go up when real interest rates decline. That tends to do well when the dollar weakens. We'll get to the dollar in just a second. Gold here, not exactly running away with the conviction that a dovish Fed might give it yesterday. Idling, not sure, not buying it. Then again, today, a rethink. Still within its range, but clearly a lot more bullish conviction here. The dollar yesterday attempts a sell-off, attempts to take the euro to a higher high. This would be the line in the sand for that. Then falters. The dollar manages to reclaim quite a bit of support here over the course of yesterday's session. Not today. It tries it again overnight, only to give it all up and end up with significant losses against the euro. Here's that yield curve. Significant steepening here as the 10-year rate comes up and the 2-year dips. All of this makes for an interesting scenario because, needless to say, what we end up with here is the Goldilocks of Goldilocks scenarios for markets, which very much brings back visions of what happened at the beginning of this year, where the markets came into January saying the Fed announced 2 months ago that they're done hiking rates and that they're minded now to cut. This means that there is some kind of a growth concern that could be occurring. So the more dovish the outlook, the better risk appetite does. And then in January, as the economic data started to get better, the market said, okay, we probably need fewer rate cuts, but not for bad reasons. We're going to get enough easing with an economy that looks to be strengthening that things will be okay. And started to extrapolate a more rosy future where you get decent economic growth, you get some degree of stimulus, maybe not more than you expected, but at least you get some sort of tailwind from cheaper credit. You have the best of all possible worlds. The difference then, of course, was that economic growth was indeed improving. And economic data flow from all around the world was getting progressively better relative to forecasts. Where we find ourselves here, certainly looking at the price action, suggests we are back in that kind of environment, whereby when the Fed offers stimulus and joins a rate cut cycle already underway in Europe, already underway in Canada, already underway in in quite a few economies, as a matter of fact. Uh, in Europe, we're not just certainly talking about the Eurozone, we're also talking about the Bank of England, despite yesterday's pause. We're also talking about the Swiss National Bank. So, but for Japan, which is, of course, a special case, where rates are just trying to climb in baby steps from having been set below zero for the better part of the past decade, we are looking at a situation where the whole of the global story is stimulus. And now that stimulus has been joined by the most influential of these central banks, the Fed, which of course is the steward of the global currency of commerce du jour, the US dollar. So when the Fed makes it easier to borrow dollars, it essentially lowers the cost of borrowing for all of global commerce. Needless to say, that's a pro-growth message. And what all of this sort of repositioning says today is that this is an environment where the stimulus comes at a time when growth is strong enough that it will bring more inflation, that it will send assets higher, hence the steepening of the curve, rather than something that is coming to help address a growth scare, whereby stimulus wouldn't necessarily be inflationary because, of course, it would be countering the disinflationary forces of a downturn. This is precisely the theory that we're going to test here at the beginning of next week as we get the first timely check of where we are on global growth dynamics. And this is where we're going to see if the market's first perspective of the Fed announcement, the circumspect version, doesn't rear its head again. And if perhaps the optimism that we're seeing now, one day hence, isn't itself vulnerable to a similar kind of seesaw. I am, of course, talking about the S&P Global PMI data that's due starting Sunday and into Tuesday. And the numbers, frankly, don't look all that awful. In fact, they look pretty well anchored, generally benign, if we look at the expectations on the table. So we're looking for a little bit of a pickup in Australia, although relatively steady, a little bit of the same in the Eurozone. No major changes expected here. A little reshuffling in manufacturing and services, but ultimately the composite index, as we can see here, is expected unchanged. Looking at the UK, similar story here, perhaps a little bit of softness, but not much. In the US, a little bit of softness in the composite, but not scary. And in Japan, again, a similar story, perhaps a little bit more softness here, but the overall story here isn't one where any of the expectations are pointing to anything particularly dire. As a matter of fact, if we look at how the global PMI situation has developed, we, of course, had some cooling of activity as we saw a little bit of a peak in May, in June and July. We can see global activity weakened, even as services bounced in the latter month, because, of course, the situation in manufacturing has become increasingly dire. So we are, at this point, idling near levels that have been carved out here through the second half of the year. August was a little bit of a pop, but we nevertheless have a tendency toward cooling over the past several months. But this is not the kind of situation that screams urgency at a time when the Fed is cutting by 50 basis points and other central banks are mainly following suit with cuts of some amount. Now, this is where things get interesting. Because, of course, as we've seen this situation develop, it is important to remember why all through this period, more stimulus has been getting baked in for every major central bank. More easing from the Bank of England, more easing from the ECB, from the Bank of Canada. The only place where you don't really get clarity here, where things are a bit choppy, is Australia. But even here, the overall trajectory is cautiously more dovish, if not as clear as it is elsewhere, despite the fact that its own central bank, the RBA itself, has been loudly arguing against it and saying that they need to keep rates higher for longer. So the disconnect is apparent. If things are generally fine, and if the markets are now so chipper, what have they been doing, baking in all of this aggressive stimulus basically since the middle of the year? Why was it that they were so gung-ho about the Fed doing this many rate cuts? And why are they expecting a lot of easing from everywhere else? Well, we can see here that while growth may be okay at headline, it has been increasingly disappointing relative to expectations globally since basically mid-April, early May. Now, we have seen a little bit of an improvement here, but note, here's the zero line. Below this zero line, data tends to disappoint relative to forecasts. The quotient here has moderated, and that perhaps suggests that the analysts forecasting data have fine-tuned their models a bit. So we're not continuing to accelerate. We're not missing by an ever-widening margin as of late August going into September, but we still are tending toward disappointment now. And that, of course, raises a very important question about this very data. The forecasts look benign, but what happens if, like global data has tended to do, this disappoints? And we end up with a picture of economic growth that is weaker than the markets have anticipated. Well, that would be a very critical revision to the optimism that we are currently witnessing. Rate cuts for an okay economy, that's jet fuel. But rate cuts for an ailing economy, that's a whole other story altogether. And so the optimism that we are seeing now, in so much as it depends on there being a benign global backdrop for growth, may well suffer a setback. And we may be vulnerable to yet another seesaw if this data misses. Now, pivoting here into the last bit of event risk for this week, we have one last central bank to think about and local inflation data ahead of that. And that's, of course, that special case that we've been talking about, Japan, where interest rates are going the opposite direction of everywhere else. Everybody is cutting. Here we have rate hikes, at least as a central tendency. And what we're looking at here is something of an interesting development. We are expecting for there to be a little bit of a pickup in inflation. And as we look at what this inflation seems to be made up of here, the critical components appear to be imported. So we can see food and energy are the hallmarks of what has this moving higher. And so we might then be looking at a situation here where perhaps if there were to be some sort of a surprise, then we could have a beckoning of the Bank of Japan to act on rates, which of course is exactly what would be considered when the Bank of Japan meets later the same day. Now, expectations here are relatively modest, and we're looking at overnight index swaps here, and we can see, not surprisingly, the 1 year is the highest of the bunch. And if we look down at the width of this spread between the 1 year and the 1 month implied rate, take that difference, we end up with 10 basis points, which is to say that the Bank of Japan is expected to deliver just one more standard rate hike. They move in 10 basis point increments rather than the 25 over the course of the next year. So the message from the BOJ here expected to be, well, we're not exactly in a hurry here. We don't need to do very much. Most of what's going on with inflation is external. We don't have a whole lot of agency as it comes to energy or food on global markets. So we're just going to hang back here and let inflation domestically come closer in line with what we want as these factors work themselves out. And that may very well give us a little bit of a different perspective on the yen here. But if this kind of inflation data is going to inspire the BOJ to faster action, because indeed their concern continues to be purchasing power in Japan, and with the Fed cutting rates, but the curve steepening, we don't exactly have a stronger yen, as we just saw right here. Since we have this steepening of the curve and higher rates in the future make it attractive once again to consider carry, and the yen is weaker as a result, maybe we get a bit of action from the BOJ. At least rhetorically, that signals this is not the correct amount. This could be higher. We could move to hike rates sooner. We might well do it within 6 months, say, or even 3. And so there could be a risk here that the yen gets an upward nudge as a result. How much that spooks the markets because they once again start to see visions of carry trades unwinding, well, that remains to be seen. And of course, to blame Japan last time was in error, as we've argued loudly here, and it would be in error this time, but that doesn't mean the markets aren't going to do it. And it doesn't mean that after the price action today, we're not vulnerable for some kind of an excuse for a correction. In any case, the dust continues to settle, and we can continue to try to figure out whether some of these dramatic swings will invariably settle into some sort of direction making before long. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what may follow. I'm on with Chris again on Fridays for Futures Power Hour, on with Victor and Tom for First Call on Sundays, back with Victor for The Price of Truth on Wednesdays, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back next week. Futures Power Hour is on tomorrow. See you then.